The January 2024 approval of US spot Bitcoin ETFs fundamentally changed institutional access to digital assets. BlackRock's iShares Bitcoin Trust, ticker IBIT, gathered $20 billion in assets within its first 60 days, the fastest accumulation in the history of the ETF industry. Total spot Bitcoin ETF assets across all issuers exceeded $50 billion within the first year of trading. For portfolio managers, family offices, and RIAs who previously faced significant operational friction in accessing Bitcoin, the ETF structure removes barriers. No custody setup, no exchange accounts, no private key management, standard brokerage infrastructure. But the ETF structure also involves costs, trade-offs, and limitations that direct Bitcoin ownership does not. This video is a side-by-side institutional analysis, examining fees, tax treatment, custody implications, and the specific mandates for which each approach is optimal. The goal is not to declare a winner but to equip investors to make the right choice for their specific situation. The structural comparison reveals meaningful differences beyond the surface-level convenience narrative. The ETF structure charges a management fee. BlackRock's IBIT is priced at 0.25% annually after its initial launch period waiver. This compounds over time. A 5-year ETF holding incurs approximately 1.25% in cumulative fees beyond transaction costs. Direct Bitcoin, held at a qualified custodian, typically costs 0.05 to 0.15% annually in custody fees, meaningfully lower for long-duration holdings. The ETF holds trust shares, not Bitcoin. Investors cannot redeem ETF shares for actual Bitcoin, cannot move holdings off-chain, and have no direct claim to the underlying asset outside the trust structure. Contrast with direct ownership, where the investor holds a claim on specific Bitcoin at a custodian or controls private keys directly. Direct ownership enables lending, DeFi participation, on-chain activity, and ultimate control. The ETF wins on operational simplicity, regulatory familiarity, and accessibility through standard brokerage accounts. Direct ownership wins on cost for long-duration holders, flexibility, and sovereignty. The access method decision depends critically on mandate characteristics. For compliance-first mandates, RIAs whose infrastructure, custody arrangements, and client agreements are designed around traditional securities, the ETF is the clear path. No new custodian due diligence, no new regulatory filings, no client agreement amendments. IBIT trades on Nasdaq like any other ETF. The compliance team can apply existing frameworks. For long-duration holders, family offices, endowments, or sovereign-style allocators planning to hold Bitcoin for 5, 10, or more years, direct custody is likely more cost-effective and more flexible. At 0.1% custody fees versus 0.25% ETF expense ratios, a 10-year holding saves 1.5% in cumulative costs on a dollar-for-dollar basis. For mandates that include any on-chain activity, Bitcoin lending, use as collateral in DeFi, participation in Layer 2 applications, or future protocol interactions, direct ownership is required. ETF shares are securities sitting outside the blockchain ecosystem. They cannot be deployed into on-chain strategies. The US spot Bitcoin ETF market consolidated rapidly around a handful of dominant issuers following the January 2024 launches. BlackRock's IBIT commands the largest market share by a significant margin, driven by BlackRock's institutional distribution network and its established relationship with allocators across wealth management and pension channels. Fidelity's FBTC is the second largest, benefiting from Fidelity's vertically integrated custody solution. Unlike IBIT, Fidelity custodies its own Bitcoin rather than outsourcing to Coinbase. For institutions with existing Fidelity institutional relationships, FBTC provides a familiar counterparty. Grayscale's GBTC, which converted from a trust structure to an ETF in January 2024, retains a large AUM base from its legacy trust but has faced persistent outflows due to its higher fee structure of 1.5% annually, 6 times IBIT's rate. When selecting among ETFs, institutional investors should evaluate the expense ratio, the custodian behind the fund, the issuer's balance sheet and counterparty risk, and trading liquidity as measured by bid-ask spreads and average daily volume. The fee differential between ETF and direct custody compounds significantly over long holding periods. On a $10 million Bitcoin allocation held for 10 years, ETF fees at 0.25% generate approximately $250,000 in cumulative management fees on a simplified basis, not including the compounding effect of fees reducing the invested asset base. Direct custody at 0.1% generates approximately $100,000 in fees over the same period, a $150,000 saving. But the true comparison must account for compounding. If that $150,000 difference were instead invested in Bitcoin at an assumed 10% annual return, it would grow to approximately $390,000 by year 10. For a $50 million allocation, increasingly common among family offices and pension funds initiating crypto positions, this scales to a $1.95 million advantage for direct custody over a decade. This arithmetic makes a compelling case for establishing institutional custody infrastructure for allocations exceeding a certain threshold, roughly $5 to $10 million, rather than defaulting to ETF convenience. 3 ETF-specific risks deserve attention from institutional investors. First, the absence of withdrawal rights. An ETF investor holds a security, not Bitcoin. There is no mechanism to request delivery of the underlying asset. In a scenario where an institution wishes to transition from ETF exposure to direct custody, to enable on-chain activity, reduce fees, or improve sovereignty, the only option is selling the ETF position and separately purchasing Bitcoin at a custodian. Any price movement between these two transactions creates timing risk. Second, custodian concentration. Multiple leading Bitcoin ETFs, including IBIT, ARKB, and Bitwise, all custody their Bitcoin with Coinbase Prime. This creates a single operational point of failure across a significant portion of the ETF ecosystem. A Coinbase outage, cyber attack, or regulatory action would simultaneously affect multiple products. Third, premium and discount mechanics. While spot ETF arbitrage mechanisms keep prices tightly aligned to NAV, periods of market stress, particularly correlated risk-off events, can create temporary dislocations. GBTC's history as a closed-end fund, where it traded at 40% discounts in 2022, is a reminder that secondary market pricing of trust structures can disconnect from asset value under extreme conditions. A clean decision framework for institutional Bitcoin allocation. Choose the ETF if your existing compliance infrastructure is securities-focused and you need to execute quickly. The 0.25% fee is a reasonable cost for operational simplicity at an early stage of crypto allocation. Choose direct custody if the allocation is large, above $5 to $10 million, the holding period is long, 5 years or more, or you anticipate any on-chain utility for the Bitcoin position. Among ETFs, IBIT and FBTC are the institutional-grade choices. IBIT benefits from BlackRock's distribution and trading liquidity. FBTC differentiates through Fidelity's vertically integrated custody, which some institutions prefer from a counterparty perspective. Avoid GBTC for new allocations. Its 1.5% fee creates a compounding drag that erodes returns versus lower fee alternatives, a relic of its pre-ETF trust structure that has not been rationalized. Finally, a transitional hybrid strategy, using the ETF for immediate exposure while establishing custodian relationships, is operationally sound for mandates expecting to build large direct positions over time. The Bitcoin ETF debate is just the beginning of the institutional crypto infrastructure conversation. Crypto Mechanics provides the frameworks and analysis that help professional investors navigate every layer of the digital asset ecosystem. Subscribe now to access analysis designed for the way institutional capital actually makes decisions.